All right, welcome back. Today we've got Ian Noble, and I found him basically through networking, but excited to learn about his story, what he's doing, and kind of where he came from. So Ian, man, welcome to the show.
Thanks for having me, John.
Yeah, excited. So looks like we've got some similar interests here, but let's kind of go back. I know you had some laundromats, but let's go back before that, kind of whether it was in school or after school. Kind of take us through your journey a little bit here.
So prior to the dry cleaning and laundry days, and I started at 21. So there wasn't a whole lot of prior life minus just having fun. I grew up in Austin. Growing up, I watched my dad in the family business, stayed around in Austin, went to the University of Texas and graduated from there. When I got out of school, it was 2009. It was a recession, or it was difficult to get a job. A lot of people are going back to school, figuring out what to do. A lot of my buddies went back to like med school or law school. And at that point, my dad had approached me and said, would you like to give this a shot? He had already removed himself from the business and the fact that he wasn't going every day. And so it was a really good opportunity. I never had planned on that being a fallback, but I'm happy that I went into it. I'm happy that he asked me because it really changed the trajectory of what I did with my life and career.
So he had laundromats? Is that what that is?
He started them. Yes. Not laundromats, dry cleaners. So a little bit different. Laundromats, you're thinking just a ton of machines that people were putting coins in. Well, not coins so much anymore, but these were people dropping off items to be cleaned, pressed, etc. But yeah, he built that in the 80s and came to Austin and opened a discount dry cleaner. It was the first in town, and then built that up very quickly. And it's still around today. It's been, I think next year, about a year and a half, they'll be at 40 years in business.
Wow. That's crazy. Yeah. So, and you worked in the business?
I did. Before owning it, I was in the business. I learned from the ground up, started pressing clothes. It's hard work. But that helped me get some respect, I guess, from the team. I was young. As I mentioned earlier, I was 21. I was the owner's kid. And I didn't want to get into a position where I was just, I had a space only because of who I was. So I really needed to show that I'm going to work just as hard as everybody else and learn every single position. And that helped as we went along the way. And I eventually bought that business. The team knew that I was there for them and would do anything side by side. I was very much an operator in that business.
So I'm curious, during the recession, I don't know if you saw a drop off, because it sounds like that's kind of when you started, but was there a drop off during the recession in this industry?
That business actually performed quite well in a recession. So relative to the competition, it was a better value, better deal. And dry cleaning is a lot of behind the scenes is the same. So the business did well during the recession. COVID, not so much. That changed the scenery quite a bit. Many businesses did great, but dry cleaning was not one of those. However, along the way, we were able to weather that storm. And then post-COVID, things turned out really nicely. Naturally, some competition shut down, and we were able to acquire their customers just organically. And now the business is doing great.
That's awesome. So it sounds like you kind of worked your way up. Did your dad at this point, sounds like he worked his way out too. So he didn't have a so-called job in the business, right? He was running the business. So he wasn't working in it. Is that right? That's
correct. I think there was some burnout too there. He started in 87. Yeah. I remember as a kid around 2000, there wasn't much activity at that point either. So I think he'd stepped away quite a while back. There was a team that was running it and doing a great job, or as best as they could. And when I came in 2010, that's when I worked with them, and we just started to turn some stuff around. It had a very good foundation, but the dry cleaning industry as a whole, and laundromats for that matter, were behind, maybe 10 years behind in technology. Mm-hmm. So it was implementing easy stuff. Point of sale system, computerizing it, marketing a little bit, things that it could have had and should have had, but didn't. And so those were the beginning years that set the foundation for that to be a successful company.
And you came in and implemented all that stuff.
I did. Yeah. That was the upside coming in. And then a few years later, we had the conversation. what's my place here? I was running it as if I was the owner from day one. And so I bought it. This was, we worked this deal in 2015, and January 1st, it became official of 2016. However, nothing changed. That was a piece of paper. I was already running it, considered myself the owner. And that was just, dad's ticket out. So I went 7 figures into debt, started paying him. Had a friendly deal though. He set up a seller finance only. So I understand that I was fortunate that I wasn't subject to the bank and their terms. It was a friendly deal just because, and everything was familiar also. So my experience exiting the business was much different because this was a new party and there was a lot to engage beforehand and due diligence, underwriting, third-party audits, things like that. But very happy how it all worked out and glad I got into that. That business, matter of fact, got me into real estate. When I was younger, I was watching my dad not go to work too much, and real estate was the ticket for him. So I think subconsciously I knew that would be something I was going to be interested in. And back in 2014, just started doing that on the side and have been involved ever since. So I love the entrepreneurship game. I love real estate and the intersection of the two. And that's what I focus my life on now.
Yeah, this is all, and we get into a lot. I do, because I've got young kids, and I look at them and I'm like, I don't want to hand them anything, but I'd love, I'm not going to force them into anything either, but I'd love for them to be entrepreneurs, because I just think to me, it's a better path. In my opinion, right? There's obviously professions. We need employees, and there's great professions out there, but I think it'd be awesome if my kids would get into it. But sounds like your dad, he didn't hand the keys over to you. He did, but he didn't just give them to you, right? He made you
That's
earn
right.
it, and made you buy it, which that's rare. And to me, I think is the right move. So how did that, if you remember, how did that kind of progress where you're like, yeah, I want to buy this. And then he was like, or I want to take over. And he was like, well, I'll sell it to you. I'm not going to give it to you. How'd that kind of look?
He needed and deserved to be paid for it. I didn't want this to be a handout. I knew that I was in a good position to begin with, just because of being so young and allowed to run this company and have full authority. So that was great in itself. The transaction, though, was setting up, we had the same lawyers, but we did purchase agreements and we had an amortization schedule and everything that you would normally have during a business, except that it was just very friendly in that manner. And I think for him, that actually allowed him to make some more money than what he was prior. There were many years to where, small business is difficult, and every type of business is difficult. And so there were many years to where, even though it was a well-ran business, it had much room for improvement, and they weren't able to get as much money out of it as they should have been. So I think for him, it was nice to finally not have to worry about the responsibility, the liability for any of the employees, staff. Because even though I was running it legally, he was still responsible for any and all liabilities. And there were crazy things along the way, things that staff would do. And, you had potential injuries we had truck drivers driving all over town. Nowadays, that's a big concern for business because you've got personal injury lawyers on every billboard. And so I know that everyone who has a fleet is very aware of this. I think he was ready to have that liability off, and I took it on, and things went okay, fortunately.
Yeah, that's cool. So fast forward a little bit. I want to get into your dad in real estate too, and then obviously you in real estate. But fast forward a little bit. What kind of happened? What made you want to sell, and how did that look?
It was an emotional decision. When I survived COVID, we finally got things back. We lost about 85% of revenue in March of 2020. I had 90 employees, 95 at the time, and we had a small management team. I was very much an operator in the business as when I was owning it. There were 3 or 4 of us in management, and a lot of it was having these difficult conversations. How are we going to cut down, put our facilities together, and make sure that we run a tight operation? When the opportunity came up to sell, it was actually just an email that I opened one day. I thought it was junk mail, but what caught my attention, the buyer, he ended up being the buyer. He had found an entity that I had that was not customer facing. And the email was scripted. I'm interested in buying, XYZ LLC. how does somebody know that? And somehow it ended up on a database, and he had certain parameters in what he wanted to purchase, a range of EBITDA, which industry. And I believe there were many discussions with owners in a variety of industries, and we just started conversations. So I was answering a cold email. And what's funny about that, I have easily 20,000 unread emails at the time. And that morning, I just decided to open that one. And it was the right timing. Again, I was emotionally burnt out. It was a decision to where my heart knew that I was so proud of running this business and always was, but I didn't have that same fire. And I thought that I was doing the rest of the team a disservice. I'm not saying I wasn't performing as as the leader of the company. I still was, but internally I had lost that drive to where I wanted to be the best every single day. So I just knew it was time. And I had, you mentioned young kids earlier. I have 3 little ones. At the time I had 2 young children. But you know how important it is if you have the ability to spend time with your children, especially at these early years. Yep. There's no replacing that, no getting it back, and all of the stars aligned. And the deal didn't just close right away. It took some time. I think probably at least over a year. Several meetings with the next buyer. I hired a broker to make sure that the business was valued properly. I hadn't sold a business before, so I knew that I shouldn't sell myself short. And the broker helped. We ended up ultimately, though, selling to the original guy that sent me that email. And he is the perfect owner. I couldn't have asked for a better guy to take over. I was talking to someone the other day. 100% of the key staff and managers are still there. And that's 2 years later, which is great. Private equity, if they would have bought it, which I'm glad that it wasn't bought by private equity, would have changed things. But he was able to keep the legacy going. And for me, I'm proud of it. I still see them doing well, talk to the team, friends with them. And so it was a very good experience for, I hope, both parties. I know certainly for me.
Yeah. That's wild. From one cold email, and you just happen to see that email.
Yeah.
Good for that guy for reaching out.
Right?
Most people don't take action, right? They may be like, oh, seems like a cool idea, but don't even reach out. So was he already in the space, or is he looking for a business, and kind of, how does that look now? What is it? Does he have multiple locations, or is he like owner operator?
He's an owner operator. I think he operates smarter than I was. The number of locations has not changed. So there were 14 when he purchased it. And this business operated under 2 names. One of them was the retail stores that had the value component. The other one was a full price convenience service that had no stores, but vehicles. So we would do pickup and delivery to people's homes. He's kept both of those names and operates them to this day, but I think he's doing it smarter, using more systems, using talent offshore to help with a lot of the task. And, all in all, though, it's small business. So there are times where a driver doesn't show up, or something goes wrong at a store and the owner has to go. If you have too many people in your management team, it's hard. That's a low profit margin business. 10, 15% is generally what people are seeking. And so you can't have too many people in management. Otherwise there won't be money, there won't be money left over. So he operates, but he's doing a really good job of separating and not just being, going every single day and have to work. I was treating stains, pressing clothes if we had a hard piece. I like doing that stuff, but I realized that probably led to my burnout as well. I was too involved and I was the bottleneck.
Yeah, for sure. And probably last question about, but I'm in real estate, self-storage facilities, but and self-storage is a hybrid of real estate and business. But I love hearing these business stories. When you did sell, and obviously that was COVID, and it sounds like you took a hit during that time. Were you able to sell off prior sales, or did that kind of discount the sales price because you took a hit during COVID?
It didn't discount it because we had finally rebounded in 2022 and 2023. So the transaction happened at the end of 2023. And fortunately, we had done well those 2 years prior, kind of back on track post-COVID. So I was thankful for that. Now, if you were to look at 2021 sales data, which it was considered, but the weighted average was real low. I forget the breakdown. We might have had 5 or 10%, maybe 5% allocated towards 2021 numbers, which were pretty awful. And then maybe 40% to 2023, and then the remaining 50%, or sorry, 40% to 2022, the remaining 50% to 2023. So it was weighted appropriately to where you're looking at the situation now and how we're valued today, which is the way that it should have been, because that's what the new owner took over when he walked in the door.
Gotcha. So you got into real estate. It sounds like your dad was in real estate. It sounds like maybe he started and then you kind of joined along. So take us through that. What's that look like?
He was always in commercial real estate. I had seen that, and back in 2014, I bought a place in 2012. It was my first house. It was near the office. Then in 2014, I bought my first
single family rental.
Single family rentals, yeah. Okay. No underwriting, not even back of napkin math. It was more of in my head, how much is my mortgage? What is the rent going to be? Is there a couple $100s to spare? And that's great. Yeah. Which this was, I listened to Bigger Pockets at the time. There was a lot of talks of, okay, if you can cash flow a few $100s per month, and being in real estate, it's a long game. Yep. You're not going, especially in single family rentals, they're not cash cows today. I think that it's a great business to be in, and over time you can build a lot of wealth, but it takes time. Yep. So I started doing that. Then I bought my first commercial property in Austin in 2017 or 18. And then I bought a few more since. So I still actively run the day-to-day stuff. What changed for me was after selling the business and it was the combination of that and having my kids. I realized that it's time to partner up. I went into my first syndication, which is, what a syndication is, but for listeners, just pooling money together. You're basically putting your funds and your belief in an operator to run a deal that you don't have to. So you guys share profits. And I found that was a great way for me, especially that year. After selling the business, I was going to have a taxable gain that I'd have to write a significantly different check to the IRS than I normally did. So for me, that strategy worked really well, getting into syndications, getting some write-offs and appreciation. We were already real estate professionals because my wife runs our Airbnbs. And so we were able to offset those depreciation K1s against our income, which was great. So I kind of fell in love with it and thought I need to be helping other business owners do that. I was bored after selling the business. I was investing for myself, but I didn't have any interaction with others. I wasn't helping anybody. And so decided to make a business out of that, to where now we are, I'll identify properties specifically in mobile home parks and private lending funds. And I'll get entrepreneurs or investors. They don't have to be entrepreneurs. We all go in as a group and co-invest. So it's been fun getting people introduced to the real estate world that necessarily may not be real estate people. They're business owners that are successful and they have money, but they don't have time. It's what we all lack, right? Yep. That was that transition since 2023. And I'm having a lot of fun doing that. More fun than the active stuff. I'm still a landlord from my active things, but I'm having more fun now.
And I want to dive into that stuff too, but it's interesting. So I left my 9-to-5 job in 2020. And now, full-time real estate investor. There's definitely a period, and probably still at times, better now for sure, but times where it's like, I want to say definitely some boredom, but also like just your who you are and what you do is kind of gone. Now it's like, well, I kind of know what I'm doing, but there's a transition. So did you have any of that where it was like, who am I? What am I doing? I just did this for, it sounds like maybe close to a decade with the dry cleaners. Was there like just a personality shift or anything in between there where you had to kind of figure out who you were?
100%. I felt great right after it closed. Then there was a period of just taking some time off, but you can't flip the switch. If you've got an entrepreneurial mindset, it's hard to turn off. And I was ready to go back in right away because my identity, and for me, was everything is tied to, on a personal level, right? This is excluding family. So family is important. I'm not discounting that whatsoever. I'm just saying for my own drive, entrepreneurship is important. I like leading and I like running businesses. So yes, it was very hard. And A lot of people don't realize though, with real estate, and if you're in self-storage, it is running a business. Even for passive investors, people ask me all the time, how do these things run passively? And the answer is they don't. There's people working really hard. You know that there's a lot that goes into this, and more certain asset classes more than others. Certainly self-storage being one of those. There's a lot of work, and people don't realize sometimes that it is a full-time job, and that's why it's been so fun putting the pieces together, because a lot of people don't want real estate to be their full-time job, but they know that they need to be in it somehow, and they've seen others that are in it. And too many, if you were to poll a group of successful people, 9 out of 10 of them have real estate or are in it, in my belief. So
yep.
People see that and there's the need for it. Yeah.
Well, without a doubt. Well, you even said, single family rentals, you're going to get wealthy over time. It's more of a savings vehicle. But yeah, I mean, there's a study done. I don't know what it is, but yeah, so I think it's 90% of like the ultra wealthy, without a doubt, have real estate in their portfolio. It may not be the only thing they do, but they definitely have real estate for sure.
They also view it differently too. You're right, because it's not only real estate, they're looking at tax strategy as one of the ways that they choose to invest in something. So it doesn't have to be a specific asset class, but to the wealthy, that is usually number one. How do I mitigate my tax burden? Which is really fun when you start to learn about it, because real estate has an unfair advantage relative to W-2 world or anything else for that matter. And that's one of those tax code laws that when you see it, you cannot unsee it. Yeah. If you're like, you're telling me that I can write off this much against my income, if you're a real estate professional, normally, other people can't. But isn't it amazing that those rules exist? And I think ultimately, even with earlier in the year, with the bill being passed, bringing back bonus depreciation, I'm hoping that a lot more people get involved now that there's more benefit for everybody.
Yeah. It's almost like now, when you're an employee, and obviously you as a business owner is a little bit different, but when you're an employee, your taxes just go out. You don't even notice it, right? It's just coming out of your paycheck. You're just seeing the bottom line anyways. But then once you become, especially a real estate professional, and you see the tax savings, anytime you have to pay some type of taxes or more than what you were thinking, it's like, why am I paying any here? So it's a completely mental, complete mind shift.
Which is hard for somebody to hear. I saw this thing the other day about an example of a doctor who makes $1 million in New York City and the taxes that they impose on them. Oh. And in this specific example, I can't validate its accuracy. The take-home pay was $476,000 out of $1 million by the time they're paying all their taxes. Now, if you took that same $1 million earner in real estate, assuming they had money to invest into deals or they're purchasing property, they can reduce their tax burden almost completely. It just depends on your setup. And so it's just amazing. And it's fun telling people about that. You hear it's like, that's cheating, right? That's not cheating. It's the tax code, but it's a mindset shift for sure.
Yep. Well, and this is like that person, right? For one, they can't work harder and make more, right? Now they can get into, and we'll probably get further into it, but they can invest with you, right? And save some money there on taxes, but they can't work harder, make more money. And it's interesting because I see it a lot, and we heard it a lot back in whenever Trump was first elected about how he was cheating on his taxes because he wasn't paying any in taxes. And we need to see his tax returns and all this stuff. 98% of the population, maybe higher than that, of the population have no idea that if you're a business owner, if you own real estate, like all these things, you may not pay taxes. And that's a good thing because the tax code is set up for you to basically pump money back into our economy, right? So you as a business owner, real estate, you're providing a place to live, you're providing jobs, so you're helping the economy go round and round. So you get a tax break for that. And most people don't know that. Most people just think, well, they should pay their fair share. Well, what's fair share, right? I mean, we can go further into that, but talk a little bit about your syndications, what you do, and then how that may help maybe that doctor you just talked about.
Sure. When I first started, my first syndication was in 2023. And I went to the first person that I knew in the industry and someone that I trusted. They are well known. They've got a good reputation. And the hardest challenge for me as an entrepreneur was putting my faith in somebody else. You're so used to having control and doing things yourself. But then you realize these people are really good at it. They have teams that help them. I don't have a team that helps me with real estate. So once you start seeing the opportunity there and the time freedom that you can gain back by letting somebody else do it, you start to, get on this path of, okay, what else can I do? Now, when I was investing, I learned a lot along the way. I've had mistakes before getting into the business. And this is what prompted me to get into the business, is learning how do you vet people properly. I'd say beyond the deal, that's the most important part of this business and my worth and role to others and our investors that go into these deals with us. You can get these marketing packets that show great pro formas, good returns. But when if you know what you're doing and you look further into them, a lot of people, it's a little bit aggressive. It's obviously marketing material and it's designed to get people into the door. But my job is figuring out, is this legitimate? Are they too aggressive? Can they increase rents like they think and decrease expenses like they're saying? Because often if there's a large discrepancy between the two, perhaps there's something that they're not telling you. And ultimately, is this a good person to invest with? Because you can have a great deal, but if a bad person's running it, it goes nowhere. So my help now towards others is I'll invest with these people first, have a relationship with these operators. I'm not running day-to-day of these deals. Then I put my own money into it. I've got skin in the game, 50,000, 100,000, whatever it may be, which is very different from a lot of investment strategies where someone might point the finger and say, this is good, or you'll earn this, but I'm going to get commission on it. This is different. We're all going in as a group. I'm only bringing it to the network because it's already a good deal for me and I'm putting my own money into it. So I like how that portion's aligned. Then I background check these people. I'm flying out to the site because I'm in Austin, but these are not in Austin. They can be anywhere that's a pro growth, job growth, population growth, these strong economic indicators that we look for. And you want to be in a good market that's going to continue to have those tailwinds. There are so many benefits to somebody having a team behind them because it is hard to go at it alone. And I found that out really quickly for myself. It's an expensive learning lesson and you don't want that happening to anybody else. And so that is the value of, for people, what I do in this industry is hopefully they're doing these things to help protect everyone's money because it's a win-win game, but everyone needs to have their values aligned before they get into something like this.
Yep. What's interesting is you said you got into syndication in 2023. In my opinion, that's probably a great time because I've got, I don't want to say friends, but there's a lot of people that are hurting right now that did syndicate that got kind of spoiled, just after COVID and really any real estate you bought from 2009, 2010 through 2022, you didn't have to do anything. It increased in price for the most part, right? You didn't really have to work hard. And then interest rates started going up. And I think a lot of syndicators signed up for short-term floating debt, which it's been a disaster for a lot of people. So I think, have you seen any of that? And yeah, it's interesting because I don't know if I know anybody that started last couple of years kind of after that big wave. So yeah, have you kind of seen that on your end?
I have. There's lots of discussion about, what could have or should have been done with the floating debt. Obviously, a lot of people got hurt. Multifamily was one of those industries, and every asset class in real estate has its cycle. What I discovered getting into the business then was, number one, raising capital was difficult. I thought that when I first got into the business, I thought this is going to be easy. People know I've already been in real estate for 10 plus years. They know that I've done okay. And it wasn't the case. You find out real quickly that, number one, many people don't have an appetite to invest into real estate, or they're not thinking outside of, or any alternative outside of the market. So, for example, if I'm speaking to someone that's been W-2 and they have a good 401k or they reinvest all their money into that. It's also been difficult to compete with the stock market. And I have to tell people, look, I'm not here to convince you otherwise. This is not for me telling you to invest with me or to work with me. Go do it with somebody else, but you do need to diversify because the market's been so good for so long. You talked about real estate. The same thing goes for the market in investing. There was a 20-something% dip in 21 or 22, and then corrected the next year in the stock market. So I think people that, you look like you're a young guy. If you've been investing, a lot of people our age didn't have a bunch of money in the market in 2008, right? They were maybe just getting started, but our parents have, and I have family members that were pretty heavily invested, and they earned their money back, but they lost time. They had to continue working because what you thought you had, you weren't going to have. So I just tell people, grow some wealth outside of your business, or if you're in W-2, start putting things in other classes that can pay you and where you're not trading your time for money. Because when that happens, at least you have some security. If one goes down, one goes up, and you're not all eggs in one basket. But 2023 was an interesting time. And a lot of people in the industry were saying, let's just survive until 2025. I think that there were a lot of hard lessons learned. And now, hopefully, underwriting gets a little bit more strict. I'm a low risk conservative investor. So I get deals pitched to me all the time and have to say no, even if I think they're okay, because that's not my territory for my business. I like private lending and I like mobile home parks, and I want boring, unsexy returns that are consistent way more than some big swing upside that the marketing brochure tells. Like, I'd rather, everybody, right? If you could rewind the clock to 2022, they don't care about the gains. What's more important is not losing your initial money. And I think there's a fear in all of us that it's unspoken that is what's important to us. Investors are emotional, whether they say it's drive by logic or not. It may be logic that gets you there, but emotion is what pulls the decision-making lever to get involved with something. And so I think a lot of people, investors specifically, were scarred from what happened in 22 and 23. And that makes it ultimately difficult for anybody in the real estate game who's raising money to gain back that confidence, not in the individual, but just in the world of real estate, because it was a rocky few years.
Yeah, for sure. So you're buying mobile home parks, and obviously they're not making any of those anywhere, right? Or if they are, it's very rare.
That's correct. Yeah, that's why I like them so much, because there's an affordable housing crisis and things are getting more expensive. Mobile home parks have a supply cap to where you're not going to see one that's built next door. So for that reason, you have some protection. And if you're going to assess what your occupancy may be, or comparing your rents to another asset class, usually we'll look at apartments. Like if you look at a 2-bedroom, 1-bath apartment in a market, you need to know that, okay, what is the difference between that and what, for example, lot rent is? And for those of y'all that are listening that don't know what lot rent is in the mobile home parks, you own a big piece of land. You have it's dirt essentially, or it can be dirt or asphalt that these manufactured homes are sitting on. And sometimes it's very common, and there's two ways. Either the park owner can own all of the homes, or a mix, or the tenants can own it. So you can still provide ownership to people. There's some pride of ownership. But just you still collect rent on the dirt or the lot itself. So it's generally a lower maintenance asset class, and residents stay a long time if they own their property. It's difficult to move them. It's expensive, $10, $12, $14,000. And so often you allow people to be a homeowner, and you can also rent out that lot, and it's an affordable rate, which is good. There's a bad stigma though, John, about mobile home parks. They now call them manufactured housing communities, but most people just think of them as mobile home parks, as being really dumpy or trashy. And there is some accuracy to that, but that's true in every asset class. There are very nice mobile home parks in communities that are geared towards, let's say, 55 and up, or just nice neighborhoods. If you go to Florida or Utah or California, they're beautiful. Nobody would ever think that, but we're not investing into these torn down dumps that nobody wants to live in. These are, where families live and where communities build.
Yeah, for sure. Yeah, no, there's definitely nice communities. So it's probably mobile home parks and storage have probably some similarities to where, no, they're still building storage, but there's also, even though it seems like you see them on every block, there's not as many storage facilities as maybe other asset classes. So is it harder for you to continue to find deals in mobile home parks? Or do you not see an issue there?
The people that I partner with, because they are the ones generally sourcing these deals, are still finding that there's opportunity. Some of the larger ones now have gained the interest of institutional money, very large parks, let's say, a couple hundred units. But there is a sweet spot that are primarily still owned by mom and pops. And I think there's a lot of opportunity there. These are hardworking people that's their life and the only income they know. So a lot of operators will, work over the course of years trying to get relationships directly with these mobile home park owners. And I do think there's plenty of opportunity out there still. There's a sweet spot from a value add component when you have over a certain number of units. So for example, if you have a mobile home park with 10 units, there's not a lot of upside, because if you increase rent by $50, it's not going to move the needle too much. But if you have a 65 unit park and you raise rents by $50, that is significant. And that is going straight to your bottom line. So there's definitely a push for parks that have more units. And generally that's what most of the operators that I work with are looking for, is something that will have a significant upside to it. But again, it has to cash flow from day one. That's the rule. It's got to be in a good market, and it has to cash flow. Even with new debt, it has to cash flow day one.
Yeah. No, it's good. Yeah. Economies of scale is so important. Well, one, it's important to get in the game one way or another, right? But then economies of scale, I don't know that many people talk about it, but there's so many advantages. And obviously, yeah, if you've got, for mobile home parks, if you've got 15 lots, there's only so much you can do with those compared to 65 or 100. It's just economies of scale. It just makes sense. You said before we kind of got on, you said you have some hobbies. What's your hobbies?
I'm a runner. So
okay.
that's my free time, but I have 3 kids. So it's tough, because if you want to run and train and you want to be present, then you have to run early in the morning. So I get up every day pretty early in the dark, put on a headlamp and go.
Yeah. What time you get up?
4:45-ish.
That is early. What time you
I
go
try
to bed?
not to go earlier. When you do, I'm in training right now. So when you're in training for a race, sometimes you have long runs, and you generally you do those once a week. And I get up a little bit earlier for those. And it's nice. You start your day getting some exercise in. It's quiet and peaceful, so that allows you to think and just be by yourself. And so that's my hobby and fun time right now, when I'm not with my kids and my wife. We like to travel too. So we do a lot of international traveling. It's slowing down right now just because we have a 6-month-old, but we're always looking to go somewhere new and explore the world.
That's awesome. What time do you wake up, or what time do you go to bed?
I need to go to bed earlier. I go to bed about 10:30. I think that I need to start getting into bed at 9:45. But
yeah, man,
there's little down. You've got little kids in nighttime. This is your downtime to relax. I get to hang out with my wife for just a little bit after doing dishes and cleaning up toys and all the mess that gets all over the house. But make it work.
I try to be asleep by 9:30, 10, and I get up at 6, and it still now during the summer it's a lot easier, right? Because you're not waking up and it's not dark for an hour and a half. But it's still, some days I'm like, I need like 9-10 hours of sleep. But it's all I'm in Ohio, it's cold, and right now it's no sun today. Who knows? We may see sun in the next couple of weeks, but you're
going to have to wait a while. I don't know. Are your kids young?
8 and 11.
Okay. So they give you a little
young,
bit more
but
free
a little
time.
older.
Yeah.
They're starting, especially the older one. They want their freedom, especially the older one. But we still try to spend as much time together.
I'm waiting for the day to where my daughter wakes up early. She's the oldest. She's 5. Okay. Where I can feel comfortable with her getting on the bike, and she can go ride her bike with me in the morning while I run. Yeah. But we're not there quite yet because too many hills and whatnot in the neighborhood we live in.
My guess is you could probably outrun her biking as far as distance.
No, she flies. Yeah, I don't know if she could keep up with the distance, but I want to figure something out to where I can get her in there with me. But it'll come. She's got a couple years, I think.
For sure. That's cool, man. Cool. Well, hopefully we covered everything here. We miss anything?
No, I think
Want to tell people where they can find you, obviously.
Sure. For the listeners of this show, we'll include in the show notes a link that is a passive investing cheat sheet. It helps people that are interested in what that world looks like, the right questions to ask, how to vet somebody if you're going to partner with them. So wish I had this 10 years ago when I was still in the, running the day-to-day of the dry cleaning business. So we'll include the link there, and my website and whatnot will be there, but that cheat sheet's going to be the most helpful for all the listeners.
Awesome, man. Well, appreciate you coming on. And yeah, we'll see everybody next time.
Thanks for following, subscribing, and listening to this episode of the Do More podcast hosted by John Farling. To learn more or ask questions, go to l4investing.com.